types of taxes. There's a fourth one we'll talk about here in a second. There's capital gains, which I've already talked about. There's not much to say about capital gains tax. The fact is it's maxed out at 15%. If that's your situation, you're selling something, there's no reason not to pay that tax. It just, unless you're leveraging into a like-kind exchange situation, paying the capital gains tax is an appropriate decision. There's ordinary income tax, there's estate taxes, and one we'll talk about here in a second is self-employment tax. This is outside the scope of what I'm trying to talk about today, but it works into taxes. It is, from a risk perspective, to put your operation into an entity that's just the operation, doesn't own assets, and to put your equity into another entity, that separates the risk so that if something bad happens in the operation, your equity is protected. There are also a lot of tax advantages about entities. Again, it's beyond the scope of what I have time to talk about today, but using entities can spread out your tax burden over multiple tax brackets. It can eliminate self-employment tax, but most importantly, it can protect risk. It can protect your assets and your collateral. An example of this is the client I work with has a general partnership. It's a mom with 2 daughters. They own that general partnership with LLCs, limited liability companies. One of the daughters recently filed for bankruptcy. First thing the bankruptcy trustee did was attempt to get to the farm's assets, which she owned 1/3 of. Without that LLC in between, they would have attached those assets. They would have got a hold of them, and the bankruptcy trustee would have taken 1/3 of the farm. Having the limited liability company in between protected those assets and allowed them to. The terms of limited liability companies say if somebody goes bankrupt, the other member buys them out at a discounted rate for over a 25-year period. It basically tells the bankruptcy trustee this is a worthless asset, you're not going to get cash out of it. So using entities to protect your wealth is both valid from a tax perspective and it's valid from an asset protection perspective. Self-employment tax. This is the one that nobody likes to pay. The best way to deal with self-employment tax is entities. Corporations don't pay self-employment tax. Limited liability companies structured the right way don't pay self-employment tax. There are a lot of opportunities to avoid self-employment tax in utilizing entities. There's also opportunities in sole proprietorship, and I don't know what level of income you guys are working with or how you structure your farms, but in a sole proprietorship, the simplest way to deal with self-employment tax is the husband hires the wife, the husband pays the wife wages in grain. There's no payroll taxes on wages in grain, so you've eliminated self-employment tax or payroll tax on that. You put her on a fringe benefit plan. That pays all the health insurance, that pays all the medical reimbursement plan, or all the medical expenses beyond insurance. All of that becomes deductible. That eliminates a lot of income, and it doesn't change cash flow. You were paying that stuff anyway. Those were expenses you had regardless. So that's one way of eliminating self-employment tax in a sole proprietorship, because you lower the income without changing the cash flow. Meals and lodging has to be done within a C corporation. Can't be done in an S corporation. Can't be done in an LLC, and it can't be done in a limited liability company. But in a C corporation, basically, you become the employee of the entity, and if you happen to live on the land, the entity says, look, I want you to live here, to watch the equipment, to watch the land, to get things under cover, to watch the grain bins, to protect against vandalism, name your poison. There's all kinds of reasons it makes you live there. Because you live in that home, groceries are deductible, utilities are deductible, you can depreciate the home, you pay all the cleaning and maintenance costs for the home are deductible, repairs on the home are deductible, all of those things become deductible. And again, those are things you would have paid for anyway, but now it's deductible. So that is the meals and lodging. Retirement plans are the other one. In a retirement plan, you can convert your grain into a retirement plan, which is full of cash, and you don't pay self-employment tax in between. Everybody's heard of IRAs. The problem with IRAs, it's only like $4,000 a year. Or you can do a simple IRA, and it's, $7,500 a year. There are, depending on your age and depending on when you plan on retiring, there are retirement plans that you can fund at a very high rate. I've seen anywhere from $50,000 a year per person to $250,000 a year per person. What happens in those retirement plans is you sell your grain, you fund a retirement plan, the sale of that grain is deductible because it went into a retirement plan. Therefore, it's not taxable income in that year. It goes into the retirement plan. Eventually, the retirement plan converts to an IRA, and it's just treated like an IRA. You've effectively moved your grain deferral into a retirement account, and you didn't pay self-employment tax in between. And you can do that one in a sole proprietorship, any kind of entity. They're very effective. They really work for the elder generation, moving the farm to the next generation. In a 5-year time frame, you can easily get rid of $500,000 to $1 million of a grain deferral and make it much easier for the next generation to take over because it's all sitting there in a retirement plan that's in your name. They don't have to buy it from you. Does anybody in here utilize grain wages? A little. In the right situation, wages and grain, it's basically this simple. The employer says to the employee, I'm going to pay you grain and cash. That's usually how it's done. You get a little bit of cash wages, and then you get grain wages. The grain is simply a transfer of bushels from the employer to the employee. Because grain prices fluctuate, and because it's grain, there's no real way to withhold payroll tax from it. The IRS, done correctly, allows you to take those wages in kind and not withhold any taxes from it, and it doesn't count as self-employment tax income. So that's another method of dealing with that situation. Ordinary income tax. There's only a few ways to deal with ordinary income tax. There's deferrals, which we've talked about. There's converting things you're paying cash for anyway into deductions, meals and lodging, those sorts of things. The other one is spreading out the income over multiple tax brackets. This could be as simple as paying your children a wage. That shows up, that's a deduction for you. It's income to them, but they have a standard deduction to offset it. Then you have them funded into a Roth IRA or something like that, which they can utilize for education purposes later, but they don't have the money to spend right now. So you can pay them $4,000 a year, put it into a Roth IRA, you get the deduction, they have income that's not taxable, and then you've funded their college education at the same time in a manner that doesn't affect college funding in the future, at least under the current rules.